Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Frank E. Holmes is CEO and Chief Investment Officer of US Global Investors. Under Frank's direction, the company has exceeded all expectations in the highly competitive ETF market, having launched the JETS ETF in 2015, a fund that shot to prominence this year, a darling of Robinhood traders, and which now commands nearly $3 billion AUM. Frank made his name in mining, receiving various awards from the Mining Journal, including Fund Manager of the Year in 2006 and Best Americas-Based Fund Manager in 2016. Other achievements include the co-authorship of The Goldwatcher, Demystifying Gold Investing, a book published with John Katz in 2008. Frank and US Global Investors have looked beyond traditional markets too, investing in the first publicly traded cryptocurrency mining firm, Hive, in 2017. Frank shares his plans for Hive and how the company's stock has surged over 1,570% this year. Enjoy the episode. Welcome to the podcast, Frank. It's great to have you on the show. How's your week been so far?
It's been a great week. And so far this year, I've been very blessed.
Good. Glad to hear it. Okay, so as we discussed before, I want to get straight into the interview, and I want to start talking about a particular product that's caught my eye, as well as many others this year, and that's the JETS ETF. So it's been in the media spotlight. It's on an upward trend right now. I mean, it's climbed nearly 40% since the beginning of last month, I think, when I just checked before our call. So firstly, why do you think this product has captured investors' imaginations to such an extent?
Well, what happened is that my board was pushing me to get into the ETF space because mutual funds were becoming just such a burden and expense, regulatory cost. You add them all up, but ETFs seem to be a lot more attractive in attracting funds. And so I've been, as a U.S. global investor, traveling all over the world, looking at gold deposits and various resource projects from oil and gas, the globe. I had noticed in 2012, 2013, 2014, my options for flying were shrinking and the cost of my tickets were rising, and because I'm flying all over the world. So I said, maybe I can get a product here, do the ETF business. There's no one else in the space. And I started doing fundamental analysis, and then I started using a quant approach and doing all these regressional scenarios. And that's where we came out to launch U.S. Global Airline ETF. And the first 5 years was just got up to $100 million. And it was sort of interesting that it exploded with the beginning of COVID, that the fund had decreased from 33, 35 trading range beginning of the year. It had fallen down to 11 and change, $12 range. And that was the bottom. And so I became really trying to figure out, where is everyone getting all their information? I know why I created it, and that was the exciting journey for me.
I said, I guess it captured the imagination of investors, but that's been no more felt other than in the retail space. So retail investors.
No. That's a great. It's not retail, just retail. What happens in a robust ecosystem is like the Great Barrier Reef, where you have all different sizes of fish. So what happened was that in the 90s, if I go back to the 90s, baby boomers discovered mutual funds and tech stocks. And there was basically no millennials really coming of any size into the capital markets. And what we found from research said that most of them were caught up with experiencing the world. Well, these kids knew everything about best hotels, best flights, what seat to sit in. They were always, as soon as they made enough money, they were traveling someplace. So all of a sudden they're stuck at home, but they know all the path, and they start going on the internet and they start doing this research to say, well, the last three crises, a year later, the airlines in the stocks are up 80 to 120%. That's what happened after 9/11. That's what happened after SARS. That's after 2009 financial crisis. So you saw them coming in, and that volume of small people pecking away, predominantly coming through the Robinhoods where there's commission-free trading. Acorn, Schwab is now commission-free, TD Waterhouse is commission-free. They started attracting all these online people stuck at home trying to make money. And this allowed the hedge guy to come in that says, you know what, I want to go short of Ryanair and American Airlines because they have so much debt, and but I want to hedge my bet by buying $10 million worth of the JETS ETF because they could see all this volume. Well, that begets more volume. And then now today we have an insurance company out of Israel that has $100 million invested, and they're up money. So I think it was the millennials allowed the ecosystem to become more robust, which attracted the dolphins, the whales, and the sharks.
Yeah. Okay. Yeah. That's such a great analogy. Yeah. That really sort of makes it clearer for me and hopefully for the listeners too. So I want to get an idea of what we should expect from the JETS ETF looking forward. We've got an effective COVID vaccine sort of in the offing. Initial rollouts begun in the UK. So do you expect this upward trajectory that we've seen in the JETS ETF recently, do you expect that to continue?
What's important for a historical, like I said to you, that a lot of people played it for this tactical bounce, is that in every time you've had these bounces over 12 months, you have these big corrections of 10%. So what investors have to realize is that when you go into something like a JETS ETF, the DNA of its volatility is greater because the airlines have a greater volatility, and historically, and that's predominantly because their biggest cost is oil. So oil is the most volatile of everything. It's more volatile than gold, the stock market, over 1 day, over 10 days, over 6 months. So that's what we're seeing that is taking place. It's this, and so the airlines will have these big 10% declines as it marches back up to this rebound. And if in the next 6 months, if it gets back to the $33 level, we're still seeing a huge return on investors' capital.
Yeah, absolutely. Yeah, I want to return to a few of those points further down in the interview. But before we move away from JETS, I saw the ETF. Now, correct me if I'm wrong, but it looks to command $2.76 billion in assets. That figure could be higher now. Obviously, it's changing all the time.
Yeah, it's a remarkable, but it fell to $35 million. We know the data, they stopped providing the data in mid-August, but there used to be a data source for how many shareholders are in a ETF on Robinhood. And we saw just before Buffett went negative on the industry, and a week after Buffett was all negative about the airlines, sold all the stocks, they jumped 50%. It was a massive surge. And we had something like 25,000, I think, retail investors had made a great score. And those that have stayed long so far are up nicely on their investment.
Yeah, absolutely. I guess the question that follows for me then, like, has the popularity of this product, this ETF, exceeded your expectations?
Oh, massively. And it's been a wonderful windfall for US Global. We're a public company. Our ticker on NASDAQ is GROW, easy to remember and grow. And it's been a game changer. We now have over $3 billion in assets, and our revenue has gone from 6 million to 18 million. Assets stay at this level, that's a huge increase. And we reported last quarter this big sea change of showing up in our revenue and cash flow. So I think everyone is happy at US Global. The shareholders are happy, the traders, because they like the daily volatility of JETS. It's got that complete day traders, tactical investors, value investors.
Yeah, absolutely. Yes, it seems a win-win for everyone all round at the moment, and a really, really exciting product that I want to talk more about later on. But let's step away from JETS and come to your background. I'm conscious that some of our listeners won't be familiar with your work, so I want to explore your background, kind of how you've come to your position today. So first off, where did it all begin for you? What was your first job in finance?
Well, Hayden, it goes way back there. I was an entrepreneur that paid for my university. I was with another colleague, a friend, busing people to rock concerts and NHL games from rural. I'm originally from Canada. They'll tell by my accent. So I like to tell people I've been here 30 years in Texas. So I'm a Tex-Can. Yeah, I'll come back, But I first was, I was an entrepreneur and allowed me to pay for my own university. And then I went into investments because I thought I had good intuition. I didn't realize that I had to still work 60 hours a week. So it wasn't just intuition, it was in synchronicity and luck. It was just a lot of effort. But I love research and I love the process of finding and discovering new companies. And I was with an entrepreneurial shop in Toronto. And my first IPO I worked on, going from a research analyst into corporate finance, was a company called Franco-Nevada, which is now today the largest gold royalty company in the world. And I was blessed to be able to have mentors like Seymour Schulich, who was one of Canada's biggest philanthropists, that was a creator of that, along with Pierre Lassonde. And that was sort of the journey of being involved with the creation of new companies and new people. And I had lots of expertise, I think, in the gold space, even though I'm not a geologist. I was a member of the Toronto Mining and Geologists Engineers Club, and would always go as a young analyst over to functions there to hear the difference in the rocks and where new discoveries were taking place.
Yeah, absolutely. And I was going to mention that you're a mining expert. You've won numerous awards in the space. The Best Americas-based fund manager I saw in 2016, and that was from the Mining Journal. And that's one of many when I was reading about your career to date. So, how did you come to specialize in that segment of the market? Why was it of particular interest?
Well, I remember studying. I was in pre-med, and I always loved sciences. And sciences are so helpful to being an investor. If you understand the laws of physics, then you can understand macro forces and movement of capital. If you want to understand entrepreneurs better, biological models of survivorship, first mover advantage to survive and thrive, are all based on biological models. Those sciences allowed me to really prosper in this business. And one of the things is a book written years ago by Think and Grow Rich. And I remember, I think 100 million copies have been sold. And it was a pilot was telling me that I must read this book. And there's a chapter in there that said you have to focus on becoming an expert in some industry or category. That's what every highly successful person, and they're just passionate about all the parts and moving parts that are involved with that industry. And so with that, Canada being known for mining, Toronto is still the mining capital of the world. From a financial point of view, you have over 100 what they call buy-side analysts in mining and oil and gas in Toronto, and another 100 sell-side analysts. So it's a rich area for mining. It's interesting if you look at that model in America. 50% of biotechnology is San Diego and Boston. Software is Seattle and San Francisco. And so you get these pockets of intellectual capital, and clearly Toronto is that space. If you're going to go into mining Africa and Eastern Europe, etc., well, the UK was always in London, was always the best place. We had the most analysts and most coverage. So that was one reason why I would quite often, if I was going to South Africa, see if I could go to London and spend several days going around and seeing the analysts in London to find out what their reconnaissance is and their information.
Yeah, absolutely. And kind of within that space, I guess gold seems to sort of obviously pique your interest and your intrigue. You even wrote a book on the subject, I believe, the Goldwatcher, Demystifying Gold Investing. And I read the full word in a couple of chapters before the call, found it really interesting. So can we just kind of let our listeners know what it's all about? Maybe you can give a quick précis.
The Goldwatcher has two authors. And the first author is a wonderful South African gentleman that talked a lot about the history of gold. And I was more caught up with when I look at how do you pick gold stocks and what is the life cycle of a mine and the 5 M's of mining. Like they understand how there are 3 major levels of risk when you're looking at a gold mining stock for simplicity. In addition to the price of gold movement, there's no doubt gold movement drives revenue and cash flow and sentiment, but you have to really know where you are on that life cycle. The life cycle of exploration to development to production is very similar to biotechnology. The exploration phase, one has to go through in the US, the FDA, or the other one has to go through the EPA. And so it's recognizing the volatility, the risks, and that's what I try to educate investors. But on the macro forces for gold, what I try to highlight is what I've coined as the great love trade. And you have to really respect this. Gold is so important for love for your family, love for your country, love for your children, love for your wife. And when we go to China and India, it's a classic example that 30 years ago, they represented basically 10% of consumption of gold and more than 60% for jewelry. And we fast track forward, and we've had nothing but rising GDP per capita out of China and India, affectionately known as Chindia. They are 40% of today's population, but their rapid growth in GDP per capita is now they're 53% of all gold demand. And what I've tried to highlight for people is that countries that own gold, when during World War II, Churchill got his gold over to Canada, and that gold was so important to be able to get funding with the Americans to build planes and tanks, et cetera, to ship them back to fight the European-German war. So it's in those that got out of Vietnam, the Vietnamese people that were out to get out early, they had gold. In fact, in modern day, the Syrians, the first to get out of the disaster in Syria 10 years ago as it evolved, were those that had gold. That's how they bought their way out. So if you love your family, you give gold. And in China, you can see that if it's the year of the tiger, you get a gold tiger. If you're born in the year of the bull, you get a gold bull. It's recognizing this sort of cultural affinity for 5,000 years is showing up. And it's the underpinning. So every time gold has a big sell-off, we see the love trade comes in and it takes it off. Then you have fear, which is about 40% of the short-term volatility. And that comes from government policies of devaluing their country's currency. And that's what leads to the sort of these surges we get to higher highs in the price of gold.
Yeah, and as you said, it's so sort of central to cultures all over the world. And as you again, you said, it underpins global economies and the way global economies work. But obviously, we're getting a lot of chatter around new technologies, blockchain, for example, and how that might disrupt that state of affairs. What's your take on that?
To a certain degree, but let's just go back to the year 2000.
Mm-hmm.
This is 21 years now, approaching 21 years. Gold has outperformed, gold has been up 80% of the time. That's remarkable. Gold has outperformed the S&P 500 almost 3-1. So gold is an important component of an asset class, and a big reason for that is because it's the fourth most liquid asset in the world. It has much portability. Now when you come to crypto, and it was the idea that I couldn't launch a Bitcoin ETF because of concerns with anti-money laundering laws. So I went into the mining, so launched the first public company mining Ethereum and then Bitcoin called Hive blockchain, which this year, I was just getting the data, is traded almost 2 billion shares and is up 1,000%. And it moves with Bitcoin and Ethereum the way gold stocks move with the direction of gold. It's a proxy for that. What I have seen is that the adoption of Bitcoin and Ethereum is growing, and it's growing rapidly as an alternative source, but I don't think it's going to replace gold. You need electricity. So you don't need electricity for gold and for bartering. And central banks keep basically the ability to keep gold as I said, the fourth most liquid asset class. It's not going to go away overnight. Now, the new kids coming on may turn around to take a look at buying Bitcoin or Ethereum, but I have noticed a big pushback still by the public because of all the hacking on these exchanges and all the negative news. So what's happened is that Hive has become a proxy for those in this space. And that's what I've noticed. So we don't have because we mine a virgin coin. It doesn't have any touch to it that would be a criminal or etc. And we can sell that into the capital markets globally, and then we pay for electricity with it. We don't have an AML concern. So that's one reason why I went into that adventure investing, I like to call it.
Yeah, that was a strategic investment on the behalf of US global investors, I believe in 2017.
It was.
can you kind of give us a bit more information about what the company does on a day-to-day basis, just to make it a little bit less abstract for people that aren't familiar with Hive?
Hive blockchain sources green energy only. And we source the energy in northern Sweden, in Boden, which is basically just south of the Arctic Circle. And we do it also in Iceland. And we do it, which is geothermal energy. One is hydro, one is geothermal. And then recently in Quebec, La Chute, which is hydroelectricity. And we're working on an acquisition, which is still not completed its due diligence, but it's to expand the operations of buying data centers now in New Brunswick, which is about 50 megawatts of energy consumption. In northern Sweden, we have 20 megawatts of capacity. And then we have to spend a lot of money on GPU chips or ASIC chips for Bitcoin mining. But we source green energy, we use the technology, and we mine in the cloud.
Great. Okay, that's because it was mining cryptocurrencies on that scale wasn't something that I was familiar with. So that's made it a hell of a lot clearer. But what's as an investor myself, and we have a lot of retail and even institutional investors listening in. What will excite them, I suppose, more than anything, is how well this company, this stock, has performed this year. I saw since the middle of last month, I believe, Hive's up 130%. And if we take that back to the start of the year, it's up over a huge 1,256%, which is extremely impressive growth. So what's been the key tailwind for Hive, do you think?
Well, first of all, we had a major shareholder, and they just were not cutting it for us, and for many reasons. But that's not as important as that they're gone, and we got total control. And our results came out this week on Monday. We filed and did a press release, this earnings webcast on Tuesday of this week, and we reported in the summer that we made $9 million. It's the biggest for any of these crypto companies to make in one quarter. So what we show is that we have the capacity, and we own a lot of these coins too. We bank the coins, we sell them to pay for electricity. We don't sell 100% of them, so we always have some inventory of them. So from that end, we are this wonderful proxy, and we have institutional investors. We have ETF investors. Fidelity was one of the early investors. It was so key for us. Our success was Fidelity wrote big checks for us to build out the beginning of our infrastructure in Canada. So we have that complete ecosystem, the retail, the family offices, and institutions, and ETFs.
Yeah, absolutely. And with a lot of investors listening in, again, that maybe have exposure to or trades or investments on Bitcoin or other cryptocurrencies directly, how much do you expect Hive's sort of stock performance to correlate with that of direct exposure to cryptocurrencies? Is it completely uncorrelated or not?
It's a great question, Hayden, because it's correlating over 92% of the time.
Wow. Okay.
Ethereum's up 3% today. We're up 3%. Yesterday it's up. We're up. If I look at 100 days, 90 of those 100 days is going to be in the direction of Bitcoin, Ethereum that day.
Yeah, that's really interesting. Yeah, quite an interesting way to get exposure to this nascent market. So yeah, one for our listeners to watch out for.
We trade in Germany. We're very liquid. We trade over the counter in the US, and we trade in Canada. But the vision that we have is to get listed in other exchanges around the world, so that Hive trades like its own cryptocurrency. It becomes a proxy for all those people reluctant to go buy Ethereum or Bitcoin. They're using us as that proxy. And because crypto trades, these coins trade 24/7, we're trying to figure out what's the best way. So we figure that we have to get listed globally. We have shareholders from 180 countries. So we have the most liquid name of all the crypto stocks.
Yeah. Okay. Really interesting. And so you mentioned an acquisition sort of pending there, and I want to get back to the company itself. So, what does the future hold for Hive? Can you talk about any sort of exciting plans on the horizon?
Well, one of the big things is notice that we want to have control of our destiny by owning the data centers and be able to lock in inexpensive electricity. It's I've just noticed that it's just better audit processes, just better controls, and also when you have your own data centers, they have a longevity to them. It's different. So I think that will happen is in the next 4 years to 5 years, Ethereum is going from a proof of work, where we do the mining to validate a transaction and get paid new Ethereum coins, is going to proof of stake, which has also started this week. That's just going to take time before that happens. But our facilities and having this sort of deep density experience now and hiring new people, this acquisition in New Brunswick will bring in the intellectual capital, I think, to help us go to the next level. Will allow us to have these data centers. Now, one of the things we've noticed, if you want to have a smart city like you have in London with cameras everywhere and watching and monitoring such, you need to have GPU chips, just like gaming industry needs these GPU chips, or animation for making movies. So there's a great long life cycle for these. And our facility in Iceland at one time was calculated, it could process 50 million instructions per second. If you're looking at films and data. So we think that by owning our own data centers down the path, that they will have a different life for them. They'll have something that's going to be important as more cities go to smart cities.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show. We talked about mining and gold specifically a little earlier on, and we probably didn't give it enough time. So I want to circle back and talk a little bit about gold specifically. So it's been a really interesting year for gold and gold-backed securities in general. I mean, the price, I believe, touched a record high this summer. Largely been on a kind of more of a downtrend since then. But I saw Goldman Sachs has actually reiterated a 12-month target of, let's see here, so $2,300 per ounce. So firstly, do you think that's optimistic? Are you as bullish on gold?
Well, when gold peaked in July, August of this year, when you look at relative strength, or we like to use sigmas, and what does that mean for your listeners? What is the rate of change? And you can look at that over different time periods. So I like to look at 20-day rates of change, which is basically 1 month of trading, 60-day rates of change, which is 1 quarter, and 1 year rates of change. So whenever you get the stars aligned, that is, they're down right across the board, 20 days, 50 days, and 1 year are down 1 standard deviation, back up the truck and buy. Whenever they're up 1 or 2 standard deviations, you've got to take some profits. So you had in August, they were up over 2 standard deviations for 20 days and 60 days, and 1.5 standard deviations over 1 year. This is going back 10 years of data. So you would expect them then to fall back to the mean for 1 standard deviation. And that's what's been taking place. Now, you ask, why is that? It's because the 10-year U.S. government bond yield hit a low of 50 basis points, and now it's at 97. So from 50 to 97 is almost 100% surge. And therefore, naturally, gold would come down because there's a huge groups of pools of capital, institutional money, that's recalibrating their bonds versus gold, and gold is their inflation. So as the yield starts to go up, they lower the gold exposure. As the yield starts the negative yield starts to rise, then all of a sudden they increase their gold exposure. So I think we're just going into this sort of resetting that trade. But I think long term, if we look at the Fed balance sheet and how much it exploded in 2008, 2009 was $3 trillion. And 3 years later, gold went from $700 to $1,900. This says that gold can go from $1,600 range was when it really started to pivot here. And it can easily go to $4,000. Why? Because there's going to be about $7 trillion added to the Fed's balance sheet. Or put in another context, is when Greenspan retired, the federal balance sheet for the biggest GDP in the world was 6% of the GDP of America. So the biggest GDP in the world, their central bank, that their debt on their balance sheet was 6% of the GDP. Today, it's 33%. It's up 5-fold. And historically, gold just goes through this sort of monetization. You start seeing get reset. the G20 countries' finance ministers, in particular central bankers, quite often live much longer than presidents and prime ministers. They're in power. And they have their own country club. And sometimes as are characterized like a cartel. And they meet on a regular basis. And it's all about synchronization of money printing to battle COVID. This is World War III, and it's invisible. So keeping the system and applying MMT, modern monetary theory, giving away money free, just keep people employed or give them checks so they can spend money, pay their rent. And if they do it as a group, clustering in different ways in different countries, but they're basically getting incredible money printing, then gold will go through a reset like real assets, like we're seeing real estate in the US up 10% over the year. Art, like Andy Warhol art, it's up also. It's so important to recognize that those real assets, and then now we're seeing with Bitcoin, it's even exploding even more so. But what happened with Bitcoin versus gold is that the supply of Bitcoin halved in May of this year. If you have the gold production supply from gold mining companies by 50%, I'm going to share with you, gold will be over 10,000. It's a simple math. So it's much more about this halving mechanism of future supply that's had this sort of, and then the buyers are always consistently buying, and all of a sudden there's less supply. It has to trade higher. And so we're seeing copper deposits, they've had a restriction in supply because the grades are less and there's been strikes, etc. And China and America are doing all this money printing, copper prices are at 8-year high. So if you have X dollars going into the system, but you have less copper, gold, wherever the commodity, or Bitcoin coming in as a supply mechanism, it resets at higher prices.
Yeah, absolutely. And we talked about sort of market volatility there and how kind of extreme market movements have been this year. And people talk about gold and it's so frequently referenced as a safe haven asset. So I wanted to get your view on how correct, how kind of valid that moniker is. Is gold still the foremost safe haven asset in your opinion?
Oh, I totally. And something else has happened here this year. There's a shortage of US dollars for many of these emerging countries for trading. And they could not set up a special repo with the Federal Reserve, another form of money printing, MMT. 15 countries were able to get it. So you saw Turkey could not get this special contract with the Federal Reserve. Well, they had to sell their gold to get US dollars. Brazil, they got it. So immediately they could get a repo with US dollars to facilitate their economy. And so these are the new mechanisms. And the other part is for investors to recognize that never before have central banks printed money. No one buys it by themselves. Then they go and buy Apple stock or Microsoft like the Swiss bank central bank is doing. Or they're buying ETFs, and Japan owns 15% of their stocks now. Their central bank of Japan basically owns 15% of the public companies in Japan. The Federal Reserve can't buy individual stock names, but what we saw this year is in buying muni bonds, ETFs, and buying corporate bond ETFs to drive down interest rates so these banks and corporations and governments, municipal governments, can roll over their debt at cheaper prices. These are all new disruptive parts of capital formation in a zero interest rate environment. So I think that gold plays a very intriguing part of that as a 10% golden rule that someone should have, prudent to have a 10% exposure and rebalance each year.
Yeah. Okay. Absolutely. Yeah. And you mentioned kind of gold ETFs and gold. Well, you mentioned sort of government's exposure to ETFs, which is something completely sort of new and unprecedented. But we've seen global ETFs backed by gold sort of explode this year. I think October was the 11th straight month of net inflows into those sorts of instruments. So that's a trend that meant, I've got the figure here. Combined total holdings came to a record $235 billion US dollars, which is extraordinary, really. So is that a trend you think will continue into 2021?
Yeah, I think we've just seen recently some redemptions have taken up place of the GLD, and that has to do with this 10-year government bond, sort of an arbitrage, they would call it.
Yeah.
Like I mentioned earlier, that we had a lot of people shorting individual airlines, but wanted to hedge it by going long JETS. And you get investors out there, institutions too, that will be longs X number of government bonds, and they want to have some gold as a hedge. I think that this is just temporary. I think that gold is basically, for me, oversold. And I think you'll probably get a pop here, a strong one going into the new year. Gold historically now surges to the Chinese New Year, sells off, and then you get this big rally going into the Chinese New Year.
Okay, great. Okay, well, one to watch out for then. And aside from direct gold exposure, investors have been backing mining stocks too. So some of the larger names have done pretty well, but so have the smaller caps. I saw actually a piece on your blog, Frank Talk, which you're pretty prolific on, by the way. Actually, why don't we talk about that for a sec? I mean, you've written, obviously, you co-authored that book. You write pretty prolifically, as I say, on the Frank Talk blog. Is writing something you enjoy? Is that a passion?
Yes, I do. And I have a process that includes investment team that create a SWOT analysis every week. I think we pushed close to 90,000 people in 190 countries around the world subscribe to some of our global thoughts. And it's a discipline. For us to do that, there's a lot of work, but you know what it does? It makes you focus on, okay, what impacted my portfolio this past week? Only 3 strengths and weaknesses. And then next week, what economic data points coming out that could be an opportunity threat? So we like to publish it because at usfunds.com, it's Frank Talk or Investor Alert, and it's always comprehensive but concise. And that helps us to reflect and think about what's moving Eastern European fund we have, or the China region we have, our global resources, which would include energy and solar energy stocks. And our newest product has been the luxury goods. It's interesting enough, luxury goods have outperformed the S&P 500 this year. One of the biggest holdings there is something like Tesla. We also have a gold quant-based ETF listed on the New York Stock Exchange called GOAU, G-O-A-U. And it's a 30% of the big royalty companies. And then after that, it's a quant-driven looking for revenue and who's the cheapest or who has the strongest revenue and cash flow momentum. What's happened that's really positive in this secular bull market in gold, which started in January of 2019, where the 50-day crossed above the 200-day. Right now, it's gone below the 50-day gold, and it's below close to the 200-day, so everyone's getting all worried. But it's done that a couple of times in this secular run in gold. And that happened from 2001 up to 2007. So in that process, what's happened here that's important is that there's better discipline at the gold producers by boards and management. And the operative word is called free cash flow. Mm-hmm. And as more senior gold producers demonstrate the discipline of only bringing on projects where there's going to be free cash flow, not stupid acquisitions, not wasteful spending, then these stocks are going through a re-rating. And the S&P 500 really was, this time last year, had a 2.5% free cash flow yield. Come March, it was gone. Guess what happened? For the first time in over 15 years, the 100 global gold producers we follow, the median free cash flow yield went positive. And it's been positive at the end of September. And this quarter here, gold is much higher this quarter than a year ago. You're going to see, once again, big free cash flow yields. That means rising dividends. That means there's stock buybacks. So I think gold stocks are going to show up as being a stronger, more credible asset class outside of gold bugs. And we saw that last quarter with Warren Buffett buying Barrick. And Barrick talks about their free cash flow yield. So does Newmont. So does Yamana. So does Gran Colombia. So that's a very important paradigm shift. When that happens, the trickle down takes place to junior mining, and is so important because explorers, most big discoveries take for junior mining. And there's been no major big 10 million ounce discoveries in over a decade. So it takes this high risk capital. There's no technological breakthrough like they found for oil and gas with frackers. So that process, you need to have risk capital going into it. We've had a shift with millennials this year that are speculating, and that's probably wise because they're young, they can make mistakes, and they can take a greater degree of risk, but you're seeing all of a sudden going into these juniors. So what we tried to do a couple of weeks ago is take 10 stocks that we like, that we have put millions of dollars into, in our fund shareholders, into these companies. We've done all our due diligence, and we featured them, and it was on a very structured discipline of 6.4 minutes. Each of them had 20 slides, 20 seconds a slide they could talk for. That's what I call the Petra Kucha model. And we let them go out to be known in the capital markets on what makes these companies a great speculative risk, but they are risky, and they are much riskier than buying a Newmont or a Franco-Nevada as a royalty company. But they do provide where if they have a big discovery, they can go up 5-10-fold.
Yeah, absolutely. One of the companies that you highlighted in that blog post that I mentioned was Magna Gold. And they caught my eye because their stock's up over 240% year to date. And that was yesterday. I'm not sure what happened to the stock overnight. But so lots of the people listening in, and we do certainly appreciate the high risk element of investments in these companies. So that's not something to be ignored. But for people unfamiliar with Magna Gold, perhaps you can just talk about maybe not them specifically. If another one's caught your eye or sticks out to you, please do talk about them. But can you talk about the investment case for a company like that, for a junior miner that a lot of us wouldn't have heard of?
The more risk you take, the more important is you bet on the jockey, not the horse.
Okay.
You have to know, is that jockey have the highest winning? And there's always fast horses, and people like to go bet on, is it going to be the next Secretariat to win the triple crown? But I say that it's great entrepreneurs, and there's a propensity for great entrepreneurs in the space, and there's only a real handful of them that find great deposits, develop them, and guys like Robert Freeland, Ross Speedy, Lucas Lundin, they just have this discipline and structure the way they function in capital markets to get great deposits or smart exploration dollars being spent. So I think when we look at these other juniors, we look at them, who's technical on their team, what's their track record in being involved with discoveries, making the discovery, and that tacit knowledge is very, very important. Explicit knowledge is pretty key also. They're geologists and engineers, but B is really what's the word I'm looking for? Skin in the game. At the same time, I've got wins. They have many wins, and they've got scar tissue. Bet on the jockey.
Good. Okay, great actionable advice for people that, like myself, won't be familiar with that market or completely familiar with it. And I said earlier I wanted to return to JETS, so we might as well finish where we started. Your expertise are in mining, as we've discussed, amongst other things, but mining's where you started. So to me, I guess JETS, from an outside perspective, seemed a bit of a departure for you and the firm relative to the other products that you're putting out. So is that fair? What's your take on that?
Oh, not at all. Everything we try to think of is global. Luxury goods is very much global, and it's rising GDP per capita. JETS was also part on the back of the rising middle class of China. And China, prior to COVID, all of a sudden their middle class was bigger than the US. It gets lost in a sea of 1.4 billion people, but they were spending more on travel. So this global phenomenon was taking place. And I know this because I travel globally, and I've got to look at all these different countries. So no, getting into the ETF space was to get into it and build a reputation of something that no one else had. There was no other airlines ETF. That's very important. Get a simple name like JETS, made it simple for people to remember. And B, sort of C was the sort of the global perspective. So it has 30 names that are airports. It has Boeing or whoever's got better results, or Airbus. It has Ryanair. It'll have Air Canada, and it'll have the big four here in the U.S. So I think it really fits into our global investing.
Absolutely. Okay. So as you said there, I mean, it's pretty much, it is the only sort of pure play product for the airline sector. Why do you think that is?
Well, it's 10%. It came out of the Wall Street Journal this week that the airlines is directly and indirectly 10% of global GDP. Employs a lot of high net worth people, from making airplanes, repairing airplanes, right down to people making $15 an hour schlepping luggage. I think that the U.S. government really showed, because they said on previous cycles they didn't realize how important the airlines was for turnaround in global travel and for local GDP. So one thing they did here was they kept everyone employed. The government, rather than giving unemployment checks to pilots that all of a sudden get laid off, they said, no, we'll give them to you, the airlines, and you've got to keep them fully employed, fully training at all times, because if you lay them off, then they have to go through FAA and go through a complete long cycle of retesting everyone, stewardess, etc. So they realize the importance for global growth and trade. So like I said, it's 10% of global GDP is related to the airline industry. And JETS is the best way to play that global trade. And if the vaccine it comes out and it's a great rating success, and the airlines surge back to where they were a year ago, then we could see still another 50% on the upside.
Yeah, okay, that's great. Yeah, I was going to ask you what your outlook there for the product was, given that obviously we do have an effective vaccine at least being started to be rolled out. So I guess my next question then is, will this be the firm's first foray into the ETF market? Will it be the first of many?
Yes, and I think there's a big push now to convert your mutual funds into active ETFs. Yeah. And so we'll go to explore that. Dimensional funds in Austin have done it. Other friends of mine are in the process of Guinness Light funds. So I think it's more tax efficient. It's where the future is. The idea of being able to trade your holdings all day long. And I think we developed the skill set. One of the big things I did as a fundamental analyst was really approaching the quant approach and using back testing rigorous. Even though past performance is no guarantee of future results, it just gives you a better batting average. And regressional analysis requires lots of computing power. Like if I want to test revenue growth for every day for the past 10 years as a factor of a universe of 1,000 stocks, it'll take 8 hours to do that. So there's 100 factors, you test them each night, and you find out that certain factors work better for one industry versus another. You also find you can't make them all equal. It may be only 3 factors, it may be 5 factors. And the weighting that you give to each of those factors is unique to each sort of industry and category. All that determination takes regressional work in detail. And that training has actually helped my active fund managers.
Yeah. Well, I could only imagine. I guess to finish on that then, and before we move on to our final round of questions, which is very much a quick fire question round, so I won't be taking up too much more of your time. The final question on the ETF space then is: we cover thematic ETFs on Opto on a daily basis. Very much sort of a strategic and key part of the output over here. Is that planned? Is that part of US Global Investors' future product range, do you think?
So we want to do things that complement us, that are unique, and so we will continue with that process. And where we have an expertise. So we have been working on some other ideas, but one thing I do know is that what JETS took 5 years of building out the brand and the awareness with the 40,000 RIAs across America, also globally, by PR and educational. We know we've received in a competitive arena in America, no load funds show up there. There's a competition and a rating system for your educational information. Well, we've received over the past 15 years 90 awards for this. So we want to make sure that our educational footprint works. So Kevin O'Leary and I are doing, he's Mr. Wonderful and I'm Mr. Gold, on December the 10th, a webcast of what we see on the horizon. We did one with JETS. He has a huge following.
Yeah, absolutely. So the perfect way to get the product's names out there, I suppose. Okay, well let's finish the interview with our quick fire question round, as I said. So this is something we do with every guest. Shouldn't take more than 2 minutes, and it's simply a light-hearted way to end the episode. You can answer in as little as 1 sentence or even 1 word if you like. So feel free to keep it nice and concise. The first question: what is the top mistake investors make?
Behavioral psychology. Understanding the emotions.
And what's the most memorable moment from your career to date, do you think?
My career, being there for the birth of a child.
Yeah. Well, hard to beat.
Ultimate of creation. But I'm thrilled, that my team, myself, we have created 7 times now $1 billion company or fund.
Yeah. Wow, I mean, it's extremely impressive. So what about if you could go back in time? If you could give yourself one tip, what would it be?
Have faith. You have to have this tremendous faith that things will unfold because of your work ethic. So I always believe that you have to have a focused work ethic, and you have to have resiliency. So the only way to have this resiliency is to have this faith that you will find a solution. That you will keep digging. That resiliency is so key to overcome physical, emotional, financial challenges, setbacks, or disappointments.
Yeah, okay, absolutely. So final question, and this is one we ask all our guests. It's kind of the Opto question, as it were. We make a point of speaking to the people, the investors, the traders, outperforming markets and outperforming benchmarks. So if you could narrow it down, or if you could give us just one sort of favorite, I suppose, what is an investor's best source of alpha?
If you're not an avaricious reader, that likes to get into the granular, it's a lot with who you know. And I mean by that is do you read about other high achievers in any category? And so coming back to that thought process, so I'm very fortunate to, as a young man, learning by mentors like Seymour Schulich and Pierre Lassonde, Ned Goodman, Toronto, when I lived in Toronto. Here, being around an entrepreneur like Rod Lewis, who I think was producing 3% of all natural gas, private, has the largest collection of World War II fighter planes, flies 600 hours a year, flies helicopters, planes, jets. And you learn from these people because they have a structure that helps them with their success. So I can know them personally, or I can read about them that I know, try to learn as much as possible of how they've had to deal with so many issues in their life. Yeah. So the alpha comes from that.
Yeah. Okay, great. Well, I think that's probably the perfect place to end then.
The last thing I want to share with you is MIT did research years ago. And what they found was, and my mother used to say this, that we all need at least 3 pats in the back or be kicked in the pants. Otherwise, you grow up mostly dysfunctional. But they found out that you needed something like 7 pats in the back, and that was a good team sports, etc. But they also found that it makes you more optimistic. And if you can be that discipline, you see opportunities differently. So if you're always pessimistic about people, places, and issues, then you will miss opportunities for getting alpha. You have to have optimism. Thank you very much, my friend.
Thank you very much. All right, great. Well, hopefully I get to speak to you again soon. Thanks for coming on the show.
Cheers.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.